Over the last 3 years, as of April 29, 2024, the IT sector is the worst performer among all major indices. The S&P BSE index has delivered just 9.02% returns as against the Sensex 14.3%. Now compare the IT sector's returns with those of the capital goods sector, which is the best performing sector during this period. The latter has delivered 45.47% returns. If you are an active investor, you would have come across the slowdown in IT sector. So what's going on? And more importantly, what to expect going forward? And is it time to invest in IT stocks? And if yes, then what stocks should be on your radar? Hello and welcome to ET Money's YouTube channel. Today, our area of focus is the information technology sector or the IT sector as it's more popularly known as. But before I start, something important. You are watching this video on our English channel. हमारे एक हिंदी चैनल भी है जहाँ पे ये सारी वीडियोस आप हिंदी में देख सकते हैं. And if you are or know somebody who wants to understand the basics of finance in a quick and easy way, we have a channel called 5 Minute Finance. I've included the links of the channels in this video's description. Alright, let's begin with quickly analyzing the reasons for the medium-term underperformance of the IT sector. Over the last couple of years, the Indian IT sector has been witnessing a slowdown. The main reason for this is the demand environment in developed countries, especially the US and European countries. Now, much of the outsourcing demand for the Indian IT services originates from the developed countries, and a number of factors have hit the developed markets over the last couple of years. These include geopolitical tensions, high inflation, and high interest rates, banking crisis in the US in the early 2023, etc. These factors have made the overseas clients of Indian IT companies cautious with their spending, and this has a cascading effect on Indian IT sector, resulting in sharply reduced demand. Another important factor is the higher demand many tech companies witnessed amid the COVID-19 period. This motivated them to overspend and overhire. Now, as the things have normalized, the excess capacities that tech companies built have been falling into disuse. Now, a look at the revenue growth numbers of top Indian IT companies by market cap can help put things into perspective. All the companies witnessed a sharp decline in their revenue growth. From double-digit revenue growth, the numbers slid into single digits. The situation was rather stark for Wipro and LTIMindtree. Wipro's revenue growth for the trailing 12-month period became a negative 0.8%. LTIMindtree's revenue growth fell from 111% in March 2022 to just 7.03% during the trailing 12 months. And it's not only the Indian IT companies that are suffering from a slowdown. In March this year, the US IT company Accenture cut its revenue growth guidance from 2 to 5% to 1 to 3%. The Indian IT sector has also cut its hiring amid demand uncertainty. As per the newspaper reports by Economic Times, the top 6 companies in the IT sector have cut over 72,000 jobs in FY24 in aggregate. Okay, so what else did the IT bosses say in the recent earnings calls that can help us understand where the IT sector is headed? In other words, where would the next phase of growth come for the IT companies? The CEO and MD of TCS said the key engagement themes which are priorities for enterprises include cloud transformation, AI enablement, customer and employee experience enhancement, business process optimization, sustainability, and early stage AI-infused transformational engagements. He also mentioned ESG and that it has gained traction amongst organizations and is becoming a crucial investment. He highlighted the substantial excitement for generative AI. Now, generative AI was a much talked about theme in Infosys earnings call as well. Salil Parekh proudly stated that they are seeing excellent traction with their clients for generative AI work. In software development, the company has generated over 3 million lines of code using one of the generative AI LLMs in the public domain. The company has put generative AI in its services and developed playbooks for each of its offerings. The newly appointed CEO and MD of Wipro, Srinivas Pallia, highlighted the immediate priority to accelerate growth. He said that every client he talked to across all industries is eager to leverage AI to shape the future of their business. Indeed, being AI ready featured in 2 of the 5 focus areas for the company. So to sum it up, while there are growth challenges at IT companies currently, there are also pockets that can drive growth in the times to come. And the one key area among them is AI. Now, in its sectoral update dated April 1st, 2024, Kotak Securities expects Q4 to be weak for IT companies. However, it expects FY25 to be moderately better. HDFC Securities, which released a report in April, expects the IT sector's growth to bottom out in Q4. it sees a gradual recovery in FY25. Lately, the top IT companies have announced their Q4 FY24 results. Let's assess if there are any signs of recovery. Let's check three metrics of the top 5 IT companies by market: revenue growth, growth of profit before interest, exceptions and tax, and change in margins. First comes revenue growth. Let's check the sequential revenue growth first. Most companies have witnessed a fall in revenue growth in quarter-on-quarter terms, but there are two notable cases: TCS and Wipro. TCS's revenue growth has remained more or less stable over the last 2 quarters, and Wipro's has improved, although it was negative for much of the year. Let's see the revenue growth of the last 4 quarters in year-on-year terms as well. Again, here as well, revenue growth has trended downwards, but the notable thing is that it seems to have bottomed out for most top players except the LTIMindtree, where the slope is quite steep. This bottoming out may be a positive sign. Next comes profit before interest, exceptionals and taxes. We will address this metric as EBIT and exceptionals. Again, let's see the sequential growth first. 3 out of 5 companies, TCS, Infosys and Wipro, have seen an upward trend here. HCL Tech and LTIMindtree have seen a dip in growth in EBIT and exceptionals. At 18.3%, Infosys growth stands out among the rest. Let's check the year-on-year data as well. The same trend is visible here as well, with TCS, Infosys and Wipro showing a recovery in their EBIT and exceptionals, and HCL Tech and LTIMindtree showing a dip in recent quarters. Infosys delivered year-on-year growth of over 21%. Lastly, let's check the margins starting with the quarter-on-quarter change. Of the 5 companies, 3, TCS, Infosys and Wipro, have seen a positive trend of margins expansion. LTIMindtree and HCL Tech have yet to experience that on a quarter-on-quarter basis. Infosys margin expansion is quite notable. The company's margins expanded by 4.75 percentage points quarter-on-quarter. But what about the year-on-year numbers? Well, a similar trend exists here as well, with TCS, Infosys and Wipro registering an uptrend in their margin expansion. Infosys stands out here too, with a margin change of 4.46 percentage points on a year-on-year basis. So how do you see this data in aggregate? Well, while the recovery is not even, there are signs that it may have started to happen, especially when we see the bottoming out of year-on-year revenue growth numbers. Of the top IT companies, TCS, Infosys and Wipro seem to be doing better. So does this mean you should invest in IT stocks now? And if yes, how should you pick best stocks in the sector? Let's see this next. Let's first talk about if it's the right time to start investing in IT stocks. The recent results from IT majors do seem to indicate that they are turning around, but honestly that's not a surety. Any adverse development overseas can derail the IT recovery. So do feel to exercise your discretion as to whether you would like to invest in IT stocks or not. Don't rely solely on this analysis and do your own research as well around where the sector may be headed. But one piece of data that can help you understand the return behavior of the IT sector. This isn't the first time the Indian IT sector is in the doldrums. In the past also, there have been phases when the IT sector failed to perform. For example, the IT index did worse than the Sensex in 2016, 2017, 2019 and 2022. But it secured a big lead over the Sensex in 2018, 2020, 2021 and even 2023. So, if you are looking to invest in IT, expect it to underperform periodically. Consider periodic underperformance by this sector as a norm rather than anomaly. And that's understandable as well, as the IT sector is so closely tied to the developed markets. Not to forget the ever-evolving, ever-transient nature of technology. This sector is rather infamous for dramatic changes that can virtually happen overnight. Now, if you want an ultra-simple way to take exposure in this sector, you can consider any of the ETFs based on an IT index. For instance, consider Nippon India ETF Nifty IT. This ETF comprises of 10 IT stocks including the sector bellwethers like TCS, Infosys, Wipro, HCL Tech and LTIMindtree, which we discussed a short while ago. This ETF or other similar ETFs can provide you exposure to the largest IT companies in the simplest manner. But if you would like to pick specific IT stocks, how can you go about doing so? Of course, you can analyze companies based on their fundamentals, business strength, management strength and so on. But given the current scenario, let us suggest a framework that you can apply. But before I do so, an important reminder, the stocks that we have discussed so far or the stocks that we will discuss now are not a recommendation. The purpose of this video is not to give you stock recommendations. Rather, it is to provide you with sufficient background information and knowledge so that you can pick stocks best suited for you. Also, the framework we are going to suggest is not the ultimate framework for stock selection. neither does it guarantee favorable investment outcomes. You can always make changes to this framework or devise your own framework. The idea here is to just discuss a logical and reasonably promising stock picking approach. Now, given that the IT sector is going through a slim phase, you can look for two kinds of companies. First, fundamentally sound companies that are currently going through a lean phase. And two, companies that have succeeded in bucking the slowdown trend. Let's first see how you can select fundamentally solid companies that are experiencing difficulties currently. For this, the starting point will be revenue growth. You can select those companies whose trailing 12-month revenue growth is less than the revenue growth for the preceding trailing 12 months. So, the revenue growth between 2023 and 2024 should be less than that between 2022 and 2023. This selection criteria will ensure that the company's revenue growth has slowed. Then, on the list of the companies so obtained, you can apply some quality criteria to filter out poor quality stocks. For IT companies, a useful quality metric is the return on equity. It is obtained by dividing the profit by shareholders' equity. Now, if you watched our video on renewable energy stocks, you might have wondering why haven't we considering ROCE or return on capital employed here? Well, you can consider that as well. There is no harm in doing so. But ROCE is more relevant when there is considerable debt in the capital structure. In the case of IT companies, debt levels are usually low and these companies tend to be asset light. So return on equity is a more appropriate metric. Let's set the threshold as a 3-year average ROE of more than 15%. And of course, remove very small companies by considering only those that have a market cap of more than 1000 crore. Now, when we applied this framework to the universe of listed IT companies, we got 37 names. You can find their names on the screen. Now, this is a big list, and understandably so, as most companies in IT sector are suffering from slowdown pains. The median return from these stocks is about 28% over the last 1 year. During this period, the Sensex returns are 20%. So in spite of the slowdown, these companies haven't done badly. Or it could be that the market is pricing the recovery. Well, that's some food for thought for you. You can use this list as your research universe to dig deeper. You can apply additional criteria on this list, such as valuations or margins or cash flows, etc., to further trim it down. Or you can increase the ROE cutoff to 20%. Or you can set a threshold for the fall in sales growth, say 10% or more. Okay, now to select the second set of stocks, that is those companies that have bucked the slowdown trend, all you will need to do is change the first revenue growth criteria slightly. You can now consider those companies whose revenue growth for the trailing 12 months is higher than the revenue growth in the preceding 12-month period. The ROE and market cap criteria can remain unchanged. Now, when we applied this criteria, we obtained a list that's on your screen now. It has just 9 stocks. You can use this list as your starting point to distill out the most worthy stocks for your portfolio. But do know that many of these stocks have delivered good returns over the last 1 year. The median 1-year returns from this list stands out as mouth-watering 77%. This suggests that many of these stocks may have already stretched valuations. So do keep that in mind. And as I said earlier, you can add additional criteria to this list to further refine it, though this one is already much shorter. Now, this suggests that companies escaping the slowdown are few and far between. But please don't consider the stocks in this list as recommendations. They are just there to exemplify the framework we suggested. You must do your own due diligence before investing in any of these stocks. Now, for your convenience, I prepared a sheet with both the lists. I have mentioned the link in the description. You can download the sheet and start your research with these companies. With this, we have come to the end of this video. I hope you found it useful. And if you did, please share it with your friends and family. I'll see you soon again with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.